Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, March 27th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. We were down 3.37% today on the S&P 500 and closed at 2541.47. And what we're looking at here is a 15-day, 15-minute chart. Each candlestick represents 15 minutes of trading on the S&P 500. And the two lines represent the short-term support and resistance levels that we are now finding ourselves in. 2350 on the S&P 500 on the low end and 2600 on the S&P 500 on the high end. And you can see this 2600 level has been acting as an overhead resistance point since really March 12th. So you can see the 12th and the 13th of March, we had quite a bit of overhead resistance right there. Poked our head above that for just a short period of time on Friday the 13th when there was some government stimulus that was aimed at the bond markets to keep the bond markets from seizing up. And of course, right after that, Monday we rolled back over and then hit the lows, at least so far, of this bear market, just below 2200 on the S&P 500. And then, of course, on the announcement of $2 trillion plus of stimulus to help fight what's going on in the globe with the coronavirus and everything that's caused from a business perspective, we had a jump up here and got back above this 2350 level on the S&P 500, which is a very important support level, and we'll take a look at that in some longer term charts. And then we've made our way back to this 2600 level, poked our head above it just for a brief 15 minutes yesterday. And then today we battled and tried to get back above and stay above that 2600 level. But as you can see, we got rejected right here in late afternoon and then sold off into the close. So when we look at a 1 day, 1 minute chart, what we can see here, and again, this is 1 day just today, and every candlestick represents 1 minute of trading. You can see that we rallied right up until just before 3:30 and got right at that 2615 level. And then we got rejected and sold off pretty hard and closed towards the lows of the session today, okay? And again, closed at 2541.47. Now, when we move to a longer chart, what we're looking at here is a 3-year chart of the S&P 500, where each candlestick represents 1 week of trading on the S&P 500. And again, we have the two blue lines representing the 2350 and the 2600 level. So this 2600 level is important for several reasons. When we look to the left here and go back to 2017, the first time we traded above 2600 on the S&P 500 was back in the latter part of 2017. And remember that prior resistance becomes support once penetrated. So once we got above the 2600 level, you can see that it acted as kind of an area of support throughout 2018 until we sold off in Q4 of 2018 right here, and then we were able to get back above that. So again, remember that prior resistance, right, when you're below it, prior resistance acts as support once penetrated to the upside. Now the converse is also true, that prior support will act as overhead resistance once you penetrate it to the downside. So when we try to get back above that, this 2600 area, it might be kind of tough, okay? And of course, the further we move up into this area here, the more we are going to have overhead resistance, as some of the people that got in back in here with new money may just want their money back, okay? That's just the way this stuff works. So anytime there's trading above you, it's very likely, whether it's in an individual stock, a sector, the whole market, anytime there's trading that has happened above where you're currently trading at, that has the potential to act as overhead resistance, okay? Making it harder to move forward. When we pull back and look at a longer term chart, and now we're looking at a 7-year weekly candlestick chart, where each candlestick represents 1 week of trading on the S&P 500. And you can see here that this 2350 level is a very important level on the S&P 500. The first time we ever got above that was back in the early part of 2017. Kind of had a little cluster of trading right around this 2350 area, and it's also where we checked back to at the end of 2018 when we had that very quick pullback in the markets in 2018. So as long as we can stay above 2350, we're in pretty good shape. But guys, I really question whether this can hold up. None of us know for sure, all right? None of us are clairvoyant. I have no ability to predict the future. All we can do is look at the charts and kind of play an if this, then that scenario out. And, you know, it's great that the government came out and threw a couple $1 trillion at the current situation, which is very, very bad for sure on numerous levels. But is it enough to say that this 2200 level that we kissed right here will be the ultimate low of this bear market? There is no way to know for sure. But keep in mind, bear markets are usually a multi-month process. The two shortest bear markets in history that I'm aware of, there was one that lasted about 3 months back in, I believe, 1990, 1991, and then one further back that lasted about 6 months. But most bear markets last, 8+ months. So the likelihood of this being a ultra short-term bear market, I think, is somewhat limited. And I'm going to show you a different chart here, do something a little bit different than we normally do, and point out an area of the market that has been very weak for a while that I don't think a lot of people have been looking at. So we're going to do something a little bit different here in just a few minutes. But if this 2350 level does not hold, okay, we need to prepare ourselves to be down somewhere in this 2000 area on the S&P 500. A lot of trading between 1900, which is this lower blue line, and 2100, the upper blue line, with 2000 as the midpoint. There was about 2 years of trading right here, okay, between mid-2014 and mid-2016. So if the 2350 level does not hold, just understand the next area of support is going to start somewhere around 2100 and go down to 1900. And again, we've already checked right here, right? We've checked the top of this 2000 area. We already did it right here for just a brief period during this bear market already. So we've already checked the top of this. So, it wouldn't take a whole lot, right? If this market starts to roll over, guys, I just want to prepare you for this. None of us know for sure. And I don't think this market is as strong as most people think it is. And based on the next chart I'm going to show you, I think you're going to understand that the market wasn't as strong coming into, February 19th, right, when we ultimately peaked in the S&P 500 at 3386.15 right here. The market wasn't as strong, I don't think, as most people think it was, and that'll all make sense here in a second. So if we roll over, just understand, probably around 2,000 plus or minus 100, 125 points, that is going to be a very realistic area to find ourselves in if we roll over. Now, let's move on to a different chart. This is the Russell 2000. The IWM tracks 2,000 small cap companies here in the United States. And what I want you to understand is we checked this 95 line, okay? Again, each one is a week, and now we're looking at a 10-year chart here. But you see this area here, the 95 area, and I drew this blue line for a reason. This goes clear back to July of 2013, okay? So this is where we pulled back at the beginning of this week. We kissed this at the end of last week as well. You can kind of see right there, and I'll zoom in on that here in just a few minutes. But I want you to understand that we've pulled back, and the small caps, the IWM, have already, during this downturn, during this bear market, traded clear back to areas that we first saw in July of 2013. So think about the damage there. Think about the weakness in the small cap area, okay, and just what that means. I mean, we've lost basically 7 years in these small caps. Guys, that's a lot of time to just basically evaporate. And even where we're trading at now, right here, okay, we closed at, 112.56. If we go to the left here, you can see that we're kind of at that top of that range, clear from 2014. Let me just draw a quick line here to make it easier to see. So here's where we closed. Just give us a little ballpark. And right in here into 2014, and just barely above the top end of the range for most of 2014, okay? So just understand that, we've already done a lot of damage here, but it may not be over. And also, let me pull us out of here, and I'm going to shorten this chart up so it's easier to see. Let's go to about a 3-year chart because I want you guys to understand that the small caps were already an area of weakness coming into this bear market. And what I want you to understand, this right here, this goes clear back to 18, okay? So this is August of 2018, and right here is January of 2020. And what you can see here, this is kind of a classic double top, but I also want you to understand, I'm going to draw another line here so we can really see this. We never, see if I can get it right at the top of that range that we hit, okay? You see that here? That's where the weekly candle closed back in August of 18. Look at this. We never closed, right? The weekly candle never closed as high, right, since August of 18. We haven't had one weekly close in the IWM, the Russell 2000 small caps, that was as high as what we saw back here. So we've been underneath. The Russell 2000 small caps have not closed at another high since August of 2018. Now, that doesn't denote a bullish market, guys. So, the large caps kept going, which is not unusual in any, long bull market like we've had here. When you have an 11-year bull market like we did, March 9th of 09 till really February, if we kind of hit the peak February of this year, right at 11 years of a bull market, that is a very long, old, tired bull market. And it's not unusual at all to see the large caps, the mega cap multinationals, outperform the small caps during the last couple of years of a bull market. It's pretty standard. Okay, so I just want you to understand that we basically did a double top here on the small caps, and the small caps since 2018 were showing weakness. Okay, so it was the large caps, the mega caps, that kept rallying. And for those people that aren't looking a little bit deeper, I believe they think this economy, this stock market, the backdrop is stronger than what it really is. Now, guys, I don't know, right? None of us know exactly where the bottom of this market is, but just understand, for the last couple of years, year and a half at least, right, we were already seeing signs of weakness in a lot of areas of the stock market. Another thing I want you to understand is I produced a video a month ago called Bond Yields in Interest Rate Sensitive Sectors, okay? And this video, I took a look at what really happened in the stock market since October of 2018 and what sectors were really leading us, what sectors were performing the best and why. So this is a super educational video. It's out on my YouTube channel. I would highly, highly recommend that you guys go out there and watch this, every single one of you. It is very educational. It's about 14 minutes long. And again, bond yields versus interest rate sensitive sectors of the S&P 500. So please go out and watch that, and I will leave a link to that video in the description box below this video. Before you go, I want to remind you to take a serious look at simple market signals. This is my risk management model that I created for myself that I'm sharing with you guys for less than $20 a month. And on the model outputs, there's a risk level signal of the overall U.S. stock market, and there's also a trend direction of the overall U.S. stock market, okay? And I worked on this for over 20 years, guys, for my own benefit. I didn't really have an idea of creating a business around it initially. I did this for my own personal trading and investing, because as much as I love technical analysis, the problem with it is it's really just looking at price action. You really cannot tell when you're looking at charts what the risk level is in the stock market, okay? So for that, I created the model that uses intermarket analysis, and intermarket analysis, of course, is where you're looking at stocks, bonds, commodities, and currencies and how they all interplay. So there's points of intermarket analysis in my model. There's breadth indicators in my model. So I'm looking at what's going on inside of the stock market. But you have to understand what breadth indicators, you have to know how to read those breadth indicators, and then you have to understand how those relate to the other components in the model, which includes measures of volatility. Again, what measures of volatility, what levels. There's price action that's in the model. But again, price action alone, I have found, is very incomplete, and it just doesn't give you a clear enough picture as to what's going on and what the risk level is in the stock market, okay? So price action is a portion of what I do, but it's only a portion of what goes into the model. And there's other things that go into my proprietary model, okay? So again, Simple market signals and my proprietary model goes way beyond traditional technical analysis. And again, the outputs are that once I look at all the data, once I aggregate all the data, the model then gives me a signal that shows me what the risk level is in the stock market, as well as what the trend direction is in the stock market. And I'm telling you guys, it helps so much. It becomes so much more powerful when you understand what the risk level is and what the trend direction is, and you combine those two components. It is super powerful, and it helps you make much better decisions when it comes to investing. So I would encourage you to take a serious look at simple market signals.